Hello, everyone, and welcome to another episode of Securities Lending Live with Pierpoint. Thanks very much for joining us. This is our first event of the year, and hopefully we'll get off to a good start. So today we thought we'd talk about the outlook for 2021, a few signals to watch for that talk about that might be signals of problems or opportunities to come. Of course, no live event or webinar would be complete without a discussion on technology, and equally true, nothing would be complete without a mention of ESG. So if we have time, we'll get to that. I hope that this is working, because just before we went live, there was a message there saying we needed to reset the channel. So hopefully this is coming to you live on LinkedIn as well as YouTube and the other channels that we're actually following on. So if anyone's sort of following us at the moment, say good morning and tell us where you are dialing in from. We have our usual competition between the Netherlands and Kent. I think the Netherlands did a strong showing at our Christmas quiz. So again, for everyone, the reality is that what we want you to do is we have what we want to talk about, and we have our thoughts and views. But the really important thing here is that we also get to hear from you. Any questions that you have, any suggestions, any comments, whether you agree or disagree with us, all of that is really useful and helpful and really gets engaged in the discussion. The other point is that although this event is live and it's best for people to join live so that you can engage in the discussion, they're also available on replay. So more people tend to watch this on replay than do live. And so even if you're watching this on replay, we go back and check the comments. So if you're watching this on replay and you have comments or questions or suggestions, please still put them in, because we will come back and we will provide comment and engagement on that. Dongi, hopefully that's how you pronounce your name, from the Netherlands. You are the first person to say hello, and the first person. So the Netherlands is well in the lead at the moment right now. And hopefully it'll be another strong showing, which will make Jeroen very happy. And speaking of Jeroen, before we get to him, first can I ask the panelists to introduce themselves? John, over to you.
Good morning, everybody. Jonathan. I'm a consultancy lead for Pierpoint. In my past, I've spent most of my career, in fact, managing agency lending businesses for a number of institutions.
Thank you. Jeroen?
Good morning, everyone. Jeroen Bakker. I'm the Benelux consulting lead at Pierpoint. 20 years experience, mostly on the buy and the sell side. Last job was the sales and marketing for a UK broker and dealer.
Thanks very much. And Julian, over to you.
Good morning, everybody. My name is Julian Eyre. I'm working with the Pierpoint team on emerging digitization and technology trends across securities finance. Thank you very much.
Great. So thanks for that. Look, one of the starting points, everyone's always interested at the beginning of the year to see what is likely to happen, because everyone's put budgets in. So what are the odds of being able to hit those budgets? Well, securities lending obviously is an interesting business from the perspective that we can't kind of create it. We don't create more widgets and hopefully have people buy our widgets. Securities lending, by definition, is reactive to what's happening in the stock and bond markets and then associated markets like derivatives. So we really need to be reactive. So it's super important for us to get a view of what's happening in the market. First, let me say that the Kent Netherlands competition now is equal. with Scott Brown actually having shown up from Kent. So it's 1-1. Now, Jeroen, if I can turn it over to you, your blog post this week talked about your outlook for the year, and you kind of broke it down in terms of trading strategies and some hot stocks.
Yeah.
I'm wondering if you could start off and get us going with
sure.
your thoughts.
Sure, Roy. Well, let me start by answering the question that you raised earlier in talking about budgets and hitting budget and those kind of things. Let's be honest, 2021 is going to be a tough year. I'm reasonably bearish on what's going to happen in the securities finance world. There are multiple reasons, and I will talk to them one by one. What my personal ideas are about what's going to happen. But the overall picture is that, yes, there is revenue to be made. However, it will be in different pockets, and not all pockets are accessible to all participants in the securities finance world. So without further ado, let me start with, I would say, that the most important indicator for securities lending demand, which is the long short activity, which is what hedge funds are doing, which is what proprietary trading desks are doing. And in order for flow to drum of flow in those areas, two things are important. One is volatility, which I think there will be a volatile year. But secondly, is it has to be more or less like a downturn market, because if everything goes up, then short positions are very difficult to keep on the book. And talking about going down or going up, I think that the majority of the analysts, if you scroll around a bit and you do a bit of research, are expecting that 2021 is going to be a bullish year from the stock markets. S&P was up 20% over 16% over 2020. They expect that the S&P 500 is going to be up for 20% over this year. So not a lot of opportunity there. So also not a lot of demand from that perspective. So if we then move on from the long short activity, which I would say is the biggest part of it, one of the other major part is the M&A activity, and M&A activity in 2020 was down, and the prospects for 2020 are very good. The low interest rates, record levels of corporate cash with companies. So there is definitely going to be more M&A activity in 2021. However, that being said, if M&A activity is being financed out of cash, so not from a stock deal or a stock takeover, that means that there is a limited opportunity, or actually no opportunity, for arbitraging those transactions. So from that perspective, there will be, I would say, a lower demand in the M&A activity. One caveat that is that from a directional short view, when M&A activity is higher, then there is a potential that there is short trade opportunity against the acquiring companies. So that was the M&A activity. And sorry,
can I just stop you there? First of all, let's talk about a little bit about sort of the long short activity, right? Because my blog at the start of the year, I think, was about, or recently was about the death of short selling. Yep. Right? It was really about this issue that you talked about, where markets ended up much higher, but the realities from the low of March, I mean, you're talking about markets that were like 50, 60%, higher to new record levels. And at that stage, often we see that, people just shut down short selling, right? They just give up. They just lost too much money at that stage. But can that also be, a point of capitulation? Is when everyone throws in the towel, is that possibly the time where it turns around, or is it just going to keep rising?
Well, maybe you should ask the Tesla short sellers. they've been thinking that the turnaround is there, and I think S3 Partners just came out with the additional numbers on the overall loss on Tesla, and everybody think, well, the turnaround is going to be there, and they're keeping the shorts on the book, but yeah, they're bleeding. So it's a bit of a crystal ball. On one hand, you think that if everyone throws in the towel, there are opportunities out there. However, we always say that the stock markets are more volatile than you are liquid. So going against the market is is a very tricky treat.
Okay, so I want watchers to know that this wasn't planned, that Jeroen would talk about sort of short sellers. First, I want to give an incredible shout out to Noel, who's actually up at 5:10 in the morning in the East Coast of the U.S. and actually watching. So, Noel, special shout out to you. But Jeroen, going back to your point about the short selling, let me just share something with you. Hopefully you guys will be able to see this. Just a second. Right. So this is from Twitter, from a thread from Fraser Paring, who's a noted short seller activist, and it's from Twitter earlier this week, where he talks about, if you're short Tesla like me at the moment, don't brag, just get your financial coffin ready. I think that sums it up.
No, true, and there are other names out there, but I think, of course, Tesla is the one everybody talks about. And but in general, if you are against the market, and if you have a short position against the market, that is very difficult to maintain. And as Fraser Paring was saying, get your financial coffin ready.
Correct. Okay, and the other thing was M&A. Again, one of our podcast guests at the end of last year, Lucinda Guthrie from Accurus, she was talking about last year as having been the year that companies actually fell in love with raising equity capital again. And that bodes super well for the business, even if the market's going to be rising. IPOs can go either way, and often the lead managers need to hedge their own positions. True.
As I said, M&A activity, I think 2021 is going to be a stellar year for mergers and acquisitions. However, it all depends on how those acquisitions or how those mergers are being financed.
Right. Okay, so we talked about a few things. Why don't you sort of carry on with other segments?
Well, there are a few more other things that I want to discuss. First of all, the convertible bond activity. There's of course a huge demand for hedging your convertible, trying to ARB the convertible. 2020 was a massive year for convertible bond activity. However, as we're all saying, that corporates are a wash of cash, so I don't expect many convertibles to be issued in 2021. So again, not a lot of demand from a securities finance perspective there. One other thing, and again, I'm afraid it's a negative. I don't see a lot of demand coming out of the index arbitrage or the single stock futures activity. Index arbitrage, of course, when traders are long the index or short the underlying. So let me say that again: are long the future, short the underlying, or the other way around. Well, if they are long the future and short the underlying, they will start borrowing that inventory from the market. However, with the increased attention to the balance sheet usage of those companies, they will first look to internalize every single stock that they have before going out into the market. So what you would call sweating your assets, they will first make sure that they have every asset utilized within their own inventory before going out to the market and start borrowing those securities. So that being said, I see a reduced demand for 2021 in those areas. And one other thing, which is the single stock futures, that's quite often used for dividend and transactions. Again, dividend payout, I expect that to be a lot less in 2021. It's going to be higher than 2020, but nowhere near the 2019 levels. So I'm afraid not a positive story on those two activities. So,
okay, can I just stop you
Yep.
there again? So everything's relative. Everything's relative, right? So as you say, the dividend payouts are likely to be higher this year than last year. So when you talk about funds that'll have an opportunity here, you're talking about tax disadvantaged funds. So you're not talking about the tax arbitrage transactions as such, but just straight up money saving by looking for people that suffer a lot of withholding tax. So
yeah. So, sorry if I may, that's quite often is that there are short positions on the book that are already there that need to be filled with inventory, and then indeed borrowers are looking to source that with more punitive tax treaty stock than non-treaty stock.
okay, so if you look at a typical, say, Luxembourg or fund, UCITS fund, there's a potential there for them to have a better 2021 than 2020, irrespective of what's happening in the specials market.
True, but if you then look back to 2019, it's still not there yet. So it's better than 2020, but not better than 2019.
Yes, but we're trying to be positive. 2021.
All right, let me give you a positive note then.
And we're gonna people in Luxembourg and Dublin are going to do better than they did last year.
They are going to be better doing in those areas. In other areas, they might suffer a bit more because of their collateral restraints. But and that's also one of the things I want to talk about, and that's where I see definitely pockets of revenue, and that's regarding the collateral transformation trades. So there will be a continuing demand for high quality liquid assets versus equity collateral in relation to the liquidity coverage ratio for financial institutions. So banks are going out there and want to borrow HQLAs versus equity collateral, preferably on term, 35, 90 days, maybe even longer than that. From a financing perspective, so finance their non-liquid assets in return for liquid assets. And on top of that as well, I think that there is increased demand for high quality collateral from a uncleared margin rules requirement. Phase 5 and Phase 6 are going to come into play this year, and I definitely see that there is going to be a demand for collateral. So if you can do those collateral transformation trades, I think you are in a good position for this year, for 2021.
Right.
Question.
Just 1 second. If I just want to say hello to Dr. Ishan Rajaram, hopefully I pronounced that correctly. We're talking about trading strategies. Interested where everyone that's watching has actually dialed in from, and if there's sort of trading strategies or ideas or themes that you think are important, please put them in, and we'll see if we can cover them off, and hide a as well to put the Netherlands in the lead. All right, sorry, over to you with a question or comment, John.
Yeah, just thinking. So, I mean, it's a generic question to all of you, but if 21 is going to be similar from a revenue point of view to 20, and let's face it, still generating revenue here. This isn't like you have a loss on your books. You may be generating less revenue, but you are still generating it. But could you argue that 21 should be a time to look internally at heavy lifting projects or things that they think they ought to be doing vis-a-vis technology that may be coming down the pipe quickly, and spend this time doing that? Or do you think firms, because revenue may be subdued, actually push that down the road further?
Well, you're saying that it maybe not be as much revenue as 2020 or 2019. However, of course, costs continue. You still have your overhead, your people on the desk, your Bloomberg terminals, the lines need to be on. So those costs will continue to have to be absorbed. And then if your cut of the securities lending revenue in total is down, yeah, then the question is, will you use that year to potentially enhance your systems or enhance your flows? Because I would think that if you are running a desk somewhere, I think 2021 should be about cost cutting. And I'm not saying that people should be laid off or those kind of things, but just in general, have a look on how expensive the process flow is, and look on what you can do to improve that. So the front end will generate the money. However, the mid office and the back end of these transactions still consume a lot of people, a lot of resources, and I think it's time for heads of desk in 2021 to have a look at that and see what they can improve on those sides.
Yeah, so I think
Absolutely true. I mean, in fact, go ahead, Ray.
yeah, just John, I think there's some connection issues on your end there, so you're kind of fading in and out. I think we'll come back and touch on that, Jeroen, with respect to technology. So John, that's I think a great point to raise, and we'll just park it for the moment. Jeroen, just a quick thing on UMR, so the uncleared margin rules. The point that you're making is that I guess the next influx is actually quite big by numbers of participants, although by value the largest participants are already in. But you're talking about a wider universe of people being affected by this.
And also that universe of peoples and corporations and entities are not always the ones that are so familiar with securities finance, while the product itself is an ideal solution for them to mitigate costs related to the UMR. So I think it's a good opportunity for a lot of people to review what they're doing and see whether or not they can enhance their offering.
Right. So look, I guess I'm a bit of a contrarian by nature, so as many people will attest to. But look, I think, from my way of thinking, we're already seeing cracks. There was some stories about different views at the Fed about whether they should continue to provide this sort of unlimited funding to the market. And I think if you see anything start to break along those lines, I think you have a potential huge swing for the markets. Although there's still the question about what's going to happen with the Biden administration and the potential there.
Yep.
And look, I think that might actually lead us into to John. I think so. Thanks, Jeroen. We might have, if we have time, we might come back for some stocks, or if people have questions about that, I invite you to put them into the podcast. By the way, if you see me looking away from the camera, it's because I'm also sort of producing it, so I'm trying to keep an eye on several things. So it's not that I'm ignoring you. I love every viewer that's actually watching. I love you individually and collectively.
I can't actually see you anymore. Is that right?
No, John, I think you're having technical issues on your end. So, but we can hear you. So why don't you take us?
Can you? Let me just check. Any good?
Yeah, John, we can hear you. So why don't
Okay,
you?
good. So let me carry on. If it starts corrupt, let me know, and maybe we'll do something different. But I think Drew's comments about it. He mentions, volatility, and we all need volatility in securities finance because it kind of generates the demand to borrow. I mean, particularly outside of regulatory drivers such as HQLA, and demand was certainly down 2020. I don't know if it's going to be relieved much in 2021. I think the short came to an end almost universally. I think careers got right.
I've actually just muted John because I think we're having trouble there. So I'm wondering whether we can skip to. Okay.
Better now?
All right. Try now, John. Yep. carry on a bit.
So I mentioned the short selling bans came to an end, so that will probably bode quite well for 21. But remember, the volatility in 20 wasn't good volatility. If you look back at what happened in March, I mean, it was all one directional panic mode, and that isn't something that the financing market particularly needs. And here you have a situation now as we get into 21 with crazy idea that we're still in the grip of this global pandemic, and yet asset prices are way overpriced in comparison. And this could typically bode well for lending, in that our market's reaching their highs and overvalued, and therefore there's all risk to the downside, and therefore sec lending could actually take advantage of that. But I personally believe it would require more horrific news in the form of, I don't know, some kind of new mutant strain of the virus, maybe wide-scale failures in the vaccine rollout. Of course, at some point we may start to see core failures in those areas that are particularly vulnerable. Tourism, airlines, etc. So maybe that will be something that we see in 21. But whilst governments continue to support markets, put a cushion under them, until that policy is reversed, and as you mentioned, Roy, there's some cracks in the Fed maybe, but until it happens, no one's going to buy the trend. And I don't see that any easing up of these stimulation packages at all. So it may be very much like 20 in terms of that. So you asked us to talk about 21, and I don't have a crystal ball. There's a couple of areas that, in my research for the news stories that I publish weekly now, I read a lot, and I avoid political comment because it's the potential for that is that it's too controversial, and it's not really what I'm there to do. But I have to read all that crap, and I must admit there's a couple of things that I'm looking at in the next 90 days. As you all know, for financial services did not take place. It was actually avoided on purpose, and you're already seeing the fact that a lot of trading in European equities has now moved to European centres, and that will continue to be the case. It was excluded from the deal on Christmas Eve by design. And so what's going to happen next is look for there's going to be a construction of a memorandum of understanding to be reached by the end of.
So sorry, I'm just gonna interrupt John again there. It's just too inconsistent, John. I'm sorry about that. I'm going to turn over to Julian in a minute, but we have a couple of comments here. So first, I'm not certain if I said hello for Rob. I think I did, because that's what put. I think that's what I put the Netherlands ahead with. And now Thomas has dialed in from Paris and asked a question, which is, do you think some beneficial owners will stop lending because of the drop in revenues expected in 2021? Drew, do you have any thoughts on that?
It's a very good question, and I think it all depends a bit on how much of the actual costs that 2020 brought with them have been incorporated. So 2020, of course, for a lot of beneficial owners was all about SFTR and getting that in place and paying money for it to make sure that it's all done. If beneficial owners think that they have turned that corner and have a reasonably I would say cost-free year, but a reasonably steady year on that particular point, I think they will continue to continue lending. It's still within risk parameters. Nothing's changed there. The revenue is still there, although it's less. But if people think, well, you know what, I've already done my investments, I don't expect 2021 to have additional big investments, then I will continue lending. That being said, the smaller ones that think all of a sudden, well, the number below the market, or the number below the line is just not worth it anymore. There could potentially be some people that are pulling out. Yes.
Well, look, along those lines, we've also had a couple of people dial in. One, Morris, Leo, thanks for your comments. Morris, I quite liked Druin's blog as well.
Me too.
And then someone I haven't spoken with in a while, Jerry Inow, is asking, because I guess of market conditions, do you expect the demand side to be less activity to be less to reduce exposure and reduce risk? So again, saying, look, in these markets that are just rising continually, do you expect the demand side to kind of fade off? So you kind of touched on that earlier, Drew, and maybe a follow up to that.
Yeah. So in short, if the markets are expected to go the way they are going, S&P up 20% expectation for 2021. I don't see a lot of demand from that perspective. So the long shorts are on the demand side is going to be down compared to 2020. Even it's definitely compared to 2020, compared to 2019. One of the things that quickly touch base on as well is in relation to the index arbitrage. A lot of the companies that are long the future, short the underlying, will avoid going to the market and borrowing their shares in order to make sure that they use their internal inventory first. So increase strain on balance sheet, which means that the bank brokers are going to be using their internal inventory first before going into the market. So again, a reduced demand there. We touched base on the single stock future, so the entire dividend play, dividend payout is going to be down compared to 2019. I think it's going to be slightly up compared to 2020, but not a lot. So no increased demand there. And what I said earlier as well is that I think that there will be pockets of revenue. However, not everyone can access those pockets easly.
Okay, thanks. Look, we'll go back to John in just a few seconds. He's redialed, and hopefully it'll be a better connection. But a couple of things that as John mentioned, the short selling bans. Malaysia has finished. Korea is scheduled to end in the middle of March, so I think that'll be a reasonable pickup. And obviously, we had a period where there were actual bans across the board or across the 9 markets during 2020. So look, I think 2021, for all the fact that it is actually less likely for sort of top end directional stuff, I think that it's more likely that there will be larger values on loan, because what you see sometimes is that as markets continually rise, the hedging is hedging at an index level. So these days, really hedging the S&P is really, Apple and Microsoft and probably Tesla now. That's where your hedging happens. So again, you have bigger values maybe on loan, smaller revenues from that perspective. But I do think there is something there. And then depending on what happens with sort of government support, I think that's the unknown entity. But I do think there's always the potential now, with such a huge rise from the bottoms, to get another shock period, another 6 to 8 week period of extreme volatility, and everyone thinks that's good, and as John pointed out, that's not so good. So John, you've got your line back again. It looks like it's a slightly better line than it was last time.
I think for next week I'll have to change location because I can see that it's not great. Let me pick up somewhere else. So ultimately, the best we can hope for between us and from the UK and the EU is some sort of equivalency. And that is the aim of the Memorandum of Understanding. And that's why it's important to notice any kind of aggression in language, positioning between now and the end of March as to how that's going to go. Equivalency is already something that the EU has granted to Japan, Switzerland, and the US. There is a downside to it, though, and it's this. The EU can withdraw at any time it wants within 30 days' notice. And I cannot see how that could be even slightest bit acceptable to the UK. So I think the question is going to remain is that, can the city, I use that as a proxy for the UK, play hardball with the EU because there are surveys that are conducted here which they will struggle to replicate on the continent. And that to me would be important as to where this goes. I mean, we know that currency is being granted in a couple of areas such as derivatives clearing and ICSDs. So it really comes down to, do you believe there will be a gradual repatriation to the European Union of functions that are performed in London at a cost at a scale and at a cost that is why it's here? And could we just see a slow demise of the city? And this is important because, 7% of GDP comes out of London, not to mention the tax revenues and the services that we export. So I'd say keep an eye on the rhetoric between now and March to see how this might go, because it could turn up in the form of volatility in the markets. So that's my first area that I will personally be looking at for the next 3 months. Shall I move on to the second, Roy? Have you got any comments?
Go ahead. No, go ahead. Go ahead.
How's it sound?
Better than it was. It's still not great, so I may interrupt you again, but carry on. Also from the audience, I'd also be interested in hearing from you whether how it sounds to you, in case it's different from what we're hearing on the headphones. So if you can't hear John or having real problems, just drop it in the comments. Thanks. Sorry, carry on, John.
So the second area that I think is worth watching is kind of a bizarre situation. I mean, normally at this time of the year, with a change of administration in the US, anticipate what the new administration is going to do in its early days, and you'd be looking forward to that. But here we have a situation where equal weight to what Trump will do next. There's no question the US is deeply divided on a lot of issues, political issues. And my concern is two things. Either Trump hunkers down in Mar-a-Lago and starts to play golf and he becomes a memory people, or he operates outside of the GOP, in the political sense, starts holding rallies. And rallies against every bill that's passed through both houses. And that, to me, will lead to a lot more social unrest than we saw in 2020. Bearing in mind, 2020 was the highest of social unrest we've seen in the US, but it was for different reasons. It was more about social injustice issues. This could be more about a political dissatisfaction with everything. And the question I can't answer, because I don't know, is the hardcore support for Trump in the tens of thousands or the tens of millions? And how he behaves in the next 3 months in particular, I think, will be telling whether that's going to show up in volatility in markets, because they need a sense of stability in the US, and yet I don't think it's come anytime soon. 75 million Americans didn't vote for the incoming administration, and there's a lot of deeply divided opinions about how that country should progress. So watch for that too. I'm hoping that he just wants to go and play golf and he's bored of politics, but my gut tells me that maybe the opposite will actually end up being true. So that's the things I'm going to be watching for 90 days.
Okay, John, thanks for that. I think we just kind of struggled that, so I think we're just going to not come back to you again. We've got some mixed comments from the audience, so thanks for that. Look, I think that those are all great points. Look, the reality is that whatever is going on in markets and that we see, or sorry, in politics that we've seen sort of globally over the last sort of I guess 8 years really, is a lot of uncertainty generally, and I don't think any one person caused it. I think this is all part of a trend, so it'll be interesting to see how it plays out. As you say, it doesn't really start with one person or end with one person, so something to watch for. Let's do a change around now. So Julian, let's talk about technology, and I also want you to make a comment about what Jeroen mentioned earlier on in terms of investing in infrastructure as well. So give us a view on technology 2021.
Roy, thank you very much. So I think that clearly business is very much underpinned by the technologies that are available to it. And the technology view for 2021 will be driven by multiple factors. There are the macro factors we've heard from Jeroen and John around the COVID impact, the fiscal support packages that the governments have put out, which has driven further stocks to new highs, which is then impacting the amount of short selling. The political landscape, which we've heard, and the Fed fiscal policy. And there's various emerging market platforms and trends, such as direct retail investment in stocks through the likes of Robinhood, where there are new market participants driving growth in the market. Secondly, there's an intermediate layer. This is driven by regulatory pressure, the revenue challenges that we've seen with a 7% drop year on year on global revenues in securities finance, stock lending. And then there are the intermediate trends, I would say, of technology. This is starting to look at wider technology trends, the maturity of distributed ledgers, the role of tokenization, the importance of interoperability across the technology landscape, and I'll touch on this again. There are new emerging buzzwords such as supervisory tech. What is this? Sup tech is the technology used by the regulators to enhance supervision and regulatory oversight. So there's a number of emerging drivers that are impacting during 2021. I think it's possible that the regulators will start to gain insight from the emerging SFTR data. The last phase of SFTR went live, I think, this month. There are new regulations such as CSDR, and there are going to be continuing regulatory pressures which confer quite high costs on the business, and technology may be an opportunity to help mitigate that. Industry-led initiatives, we've seen quite an important activities from the trade associations, looking at things like legal technology and legal tech, reg tech I've mentioned, and the emerging initiatives around data and process standardization, where the trade associations are starting to define industry best practice and codify that. Some of the emerging fintechs are then offering this as a digital technology that then need to be consumed by the business. As Roy, I think you'll probably get to in a second, ESG is going to become an increasing factor, and what role was technology play in understanding this? A question that I would raise with Jeroen is that do we see any increasing volumes and activity in emerging markets for securities financing and stock lending? If we think that the core Western markets, the traditional markets of Asia, Europe, and the US have seen a decline in revenues through different macro factors affecting volumes and revenues, is there an opportunity to turn to focus on emerging markets? If emerging markets are going to be an opportunity in the stock lending world, what data and information is going to be critical to drive liquidity and volumes in these sectors? And I think this is going to be a factor to consider in 2021. I think there's also the potential for new products to develop. And this is, again, an area that the business will be looking at, where they can differentiate their service offering or product offering through new product development, and having technology which supports and enables new product development is going to be fundamental. So that leads us really to a micro level view. And by micro level view, I mean firm specific, market participant specific adoptions, strategies around digitization and technology in 2021. There are a number of drivers. These impact the banks in a number of different ways. So legal technology, I think, is a good example that there is increasing investment in thought leadership and intellectual property driven by the trade associations, not least if we look across the industry to adjacent sectors, the role of ISDA and their digital contract codification and digitization. Isla's initiative on legal technology aligning with ICMA's, looking at the codified level, granular level codification of GIMSAs and GIMRAs. This is quite a quick win for banks and organizations to look at, because it will require clearly a budget and an investment, but the business case may deliver in-year return on investment. Increasingly, sorry?
No, carry on. I do want to, as you say, we need to get down to the micro level, right? For people to sort of move ahead in technology in an environment Jeroen was talking about where revenue is going to be challenged. It is that kind of micro level, firm by firm, what can they do that will actually create an investment that will give them a payback within a reasonable amount of time? That really is the question that I think everyone is struggling with and needs to answer.
So Roy, I understand. I think that understanding the context is critical to look at the business case, looking at impacts to improve client service and client benefits, to reduce friction across the bank and across the market horizontally. So there's two views. There's the within bank technology and innovation agenda, and then there's a horizontal industry interaction capability for technology to support it. Against that, there is a conflict driven by the cost of change and the complexity of change. So where is the focus? I think legal technology is a good example. Making sure that the business is engaging with the IT departments, the technology units, understanding what the available technologies are for innovation. How does that innovation then drive a business case? In the land of GC, there are already organizations with very high STP rates, and STP rates are direct proxy for cost. The higher the straight-through processing, the lower of cost of processing is likely to be. So that's an in-bank model. As soon as the straight-through processing goes outside of the bank, there are requirements for common standards, APIs and data formats and structures that start to drive a need then for reconciliation costs, exception management. There are quite a lot of economic drivers to look at efficiency and increasing straight-through processing within bank and out of bank. How does this then happen? One of the key initiatives, which I know that you're familiar with, is the common domain model. This really seeks to smooth and accelerate and enable the ease of data and process alignment across an industry. This seeks to drive standardization. But at the very highest level, this probably involves quite a significant cost investment and very strategic agenda. In 2021, I think that the business will need to look at a 3 to 5 year strategy. How do all of these technologies align with the business agenda, both cost reduction and revenue increase, looking at mandatory obligations that they have across regulation, aligned with new emerging value channels such as ESG and emerging markets. Once that high-level strategy is defined, tactical activities needs to be looked at. How would they achieve this? I think that there are benefits to looking at a current state review. This is a traditional consultant approach, I think, to try and understand critical pain points and challenges in the trade and process lifecycle. An example where we know there is increasing focus is in allocations and reallocations. How is this process managed today? How complex is that process? What are the manual touch points? What are the risks to the business associated with streamlining and managing allocations and reallocations? And can technology support that?
Yeah, so look, I think that's a great point to just kind of stop and kind of look at where we are with this again, because I think that's what we're trying to do, right? The idea here, and this is certainly what all of our discussions have been with the wider community over the last sort of I guess 6 weeks now, is to say, right, let's you talked about this kind of traditional consulting approach where you look at sort of pain points. I think a lot of firms know the pain points that they actually touch, and it's a matter of us sort of working with them to identify what can be done that will actually give them a payback within a calendar year. Right, that's the challenge, right? If you can go to someone and say, "What are the things that are causing you problems and costs? Is there a solution that's available?" Because again, CDM and the whole idea of digitization, all of that starts today in this technology environment, doesn't require a complete refit into DLT and a leap of faith, right?
But Roy, I think you're correct that there is a risk, though, in this model, and that is that one bank's challenge may not be the same as another. And we end up with a federated, multiple solution approach, each one only giving a small business benefit. If we could see the industry aligning with certain specific key issues that could be addressed sooner, and we could help the industry align with a solution to solve for that, actually the return on investment scales very, very well, working collaboratively.
Right. And that's what, so for anyone that's actually watching this live or on replay, that is what we've been talking to people about, is to find that kind of commonality of pain and try to identify solutions that have enough scale to be able to create that kind of payback. Right. So if you haven't heard from us, you will do shortly. If it's something that's particularly keen and high on your agenda to actually get a return for your investment money in your infrastructure, get that payback this year, then if we haven't reached out to you yet, please give us a shout. So, Julian, maybe if I can ask you to do sort of a wrap up on your comments.
Yeah. So I think from my point of view, 2021 is also going to be an opportunity for banks to collaborate on these areas where there is no competitive or limited competitive advantage. We completely recognize that in some organizations, technology is a key differentiator, but there are quite a lot of business processes that are high cost, relatively high risk, that don't give competitive advantage, that could be addressed on a collaborative basis. And that collaboration involves market participants as well as the wider industry landscape, including trade associations being aligned with initiatives and agendas that they're driving, as well as the market infrastructure providers who need to be included in this overall strategy to decrease cost, increase efficiency, and to provide a new foundation on a strategic basis.
Okay. Cool. Right. So I'm going to, there's just one other thing I want to talk about. We've covered off sort of the trading strategies. We've talked about technology. We've talked a little bit about sort of market events that might impact us. One of the challenges that I think people face is in 2020, everyone got used to working from home. People had less commute time. They had to adapt their sort of their work practices. And a lot of people spent time doing courses and paying attention to or attending live webinars. So one of the things that I think will be a challenge this year is not every live event that happened this year will happen, or happened last year will happen this year again. And even if they are, I think everyone is kind of all zoomed out in many cases. And so if you're going to be spending time watching events, what you want to do is make certain that they answer questions that you have. So we've done some research into the wider securities finance community. And one of the things that we have decided to do is launch the Purepoint Alpha community. So I just want to touch on it briefly. So the idea here is that, what's this? Hold on a second. I just want to show this to you. So the idea of the PAC, the PAC, is that it's kind of a closed community of subscribers. So those subscribers might be individuals or corporates that actually sponsor multiple employees and their teams. And the idea of this is to continue very focused sort of self-development and self-investment in the business. So what we're going to be offering when we go live on the 25th of January is that members are actually going to have access to live tutorials, mini courses. We're going to have premium content with either more detailed blog type articles, but only for members, videos, interviews, and podcasts that are with sort of experts, but where we dig in more depth. So this gives people an opportunity to not only continue to get investment and education in it, but also have access to experts. One of the things that we heard from a lot of the people that responded was that information that they would like to have is often available in their firm, it's present in their firm, but not necessarily available to them or accessible. It's in the hands of relatively few people. And so people don't always have the opportunity to ask questions, or sometimes they don't want to ask questions from colleagues. So the idea is that every month there'll be live events. Those live events will be recorded and then be part of a library. And there'll also be a community forum. So I'll just quickly show you the community forum. So the membership benefits, in addition to all of the training and education, access to experts, there'll also be discounts and savings on events that we're part of or training courses that we offer, right? So now the training courses cover securities lending, collateral management, and repo. We have a number of other ones that are actually being added. But there's also this idea of the general discussion. So this is just a general chat about securities finance related issues, the learning and development segment, and then also a forum for questions on trading, technology, operations, repo, and then sort of also a feedback list. So we want the site to keep developing. So the idea here is that people will have an opportunity to ask questions that actually are of interest to them, things that they want to know the answer to. And we'll also be bringing more sort of experts and guests, and we've got people lined up. I think someone today on the call, Julian, might have mentioned emerging markets. We have people lined up to do tutorials in how some of these emerging markets actually work in detail. So the community, it goes live on the 25th of January. There are membership obviously is open now. And if you sign up now, you can get a discount and save even more money and make it even more valuable to you. So I'll just do a quickie on that. This is the pricing. There's corporate sponsorship as well for 10 people or more. So have a think about that. You should see some more marketing material coming from me in the very near future, but sort of keep an eye out for that. It's a chance for you to kind of develop your career. And kind of as we talk about it, the alpha community is a way for you to add alpha to your securities finance career today. Anyway, look, that's the final pitch on that. That's kind of a wrap. I want to thank the panelists and the speakers. So thanks for that. And John's John's connection seems to have powered back on, and now
I'm now 10 by 10.
Yeah. Perfect time, John. So thanks for that. But look, keep there he is. Keep with your comments and questions. Really appreciate. There's some great questions today. If you're watching this on replay, again, add other questions or comments in there. We will review them and comment on them. If you want to talk to us about what we're doing on the technology side, as Julian was talking about, give us a shout. I didn't talk about ESG today. We'll shift that over to next week because it's too important to just skip over. So again, if you didn't see it, look at my blog post from not this Tuesday, but Tuesday before, where I looked at a specific fund that has allegedly stopped doing securities lending because of ESG concerns. I think those are all valid concerns, but not necessarily relevant to that individual fund. So mostly thanks everyone that took time to watch us. Noel, if you're still on, I think that's pretty amazing because it's now 6 a.m. But thanks for dropping by anyway. Maciej just managed to join in at the end here, so thanks for joining. And he's part of the mastermind behind the technology enabling the PAC, the Pierpoint Alpha community. So thanks again, everyone. See you next week, where we will be talking about ESG and more. Thanks again.
Thanks very much.